For the first time in history, Moody's has officially downgraded the United States credit rating from AAA down to AA1. This is not a drill. This is a major moment in financial history, and today I'm going to break down exactly what this means for your portfolio, your money, and the markets moving forward. Let's dive in. But before that, you're probably wondering, Marco, why are you wearing this outfit? It's because I want to support our struggling American companies overseas. How are these Vietnamese children gluing your Nike shoes together going to eat their bowl of ramen if we don't put them in these factories? Let's get into it. Okay, so this isn't the first time the U.S. has actually seen a downgrade. So back in 2011, S&P dropped our credit rating from AAA to AA+, and the markets didn't take that lightly. Before I show you that, I want to actually explain this chart right here. So the ratings agency is up here. You can see dark blue is Moody's, pink or purple is S&P, and then the aqua blue is Fitch. So you can see the first time in 2011, S&P dropped that right here. The second time was Fitch. That was in 2023. And then the third time, for the first time in history by Moody's, was just a couple days ago. So if we go into the aftermath, let's see what happened here. So after the 2011 drop, after S&P downgraded us, the S&P 500 fell nearly 8% in just 2 months. So the S&P 500 is the blue, the greenish line right here. I know it's kind of hard to tell, but you can see right after that, it just bounced right back. So I don't want this to sound alarmist. You can see the 10-year Treasury yield fell by 35%. That's the pinkish salmonish line. It did spike back up, but also started to keep falling pretty precipitously in the months after. And then if we fast forward to 2023, when Fitch downgraded us, you can see that they cited like ballooning debt, fiscal inaction, Fed rate hikes. I don't know if you guys remember this time. This was only about a year and a half ago, 2 years ago now. The S&P 500 dropped 10%. So the S&P 500 is this green line right here. But then again, it just bounced right back after a couple months. So what I'm trying to get at is you may see a dip for the next month or so. And then after that, up and to the right, baby. Dollar cost average, buy the dip. Don't be a coward. Okay, so if you look at this, the Russell also got smoked. It was down 17%. And unlike 2011, yields actually surged 23% instead of dropping. Again, that's only after the first couple months, and then they dropped back again. So why the flip? Well, it's simple. So the concern has shifted from political gridlock to the actual sustainability of U.S. debt, which I've been talking about on this channel for many years now. Okay, so why is Moody's doing this now, even though we've seen Fitch and S&P downgrade us in the past? So they're citing that they project the federal deficit to hit 9% of GDP by 2035. This is up 6.4% this year. You can see this green line is basically just the federal total public debt. And then also debt to GDP ratios to spike to 134%, which we saw here. This is higher than even World War II levels. Even though we did come back down, it is starting to rise back again, and we are above 120% of debt to GDP. And the most alarming out of all this is that interest payments could consume 30% of federal revenue by 2035. So for context, that number is only 18% today, you guys. That's a 66% increase in just over a decade. But again, not to be alarmist, let's put this all into perspective. So this chart right here shows you all the credit rating scales by agency. And then here's Moody's, S&P, and Fitch. They all mean the same thing. The tiers mean the same thing, just the numbers or lettering may be a little bit different, the nomenclature. But if we look at Moody's, we basically went from AAA to AA1. So we went from prime to the highest tier of high-grade credit, okay? So again, I know this makes headlines, it makes everyone kind of scared, but you know, we're not even close to being, you know, lower medium grade or even upper medium grade, okay? You get into like junk bond territory or junk credit rating territory when you start to get into the double B plus and then the double B ones here.